Well, joining us now is Truist Chief Market Strategist Keith Lerner, Crossmark Global Investment CIO Bob Dahl. Guys, welcome. Keith, this market's been sort of staggering back and forth for about 2 months. I know you don't love tech in general right now, but what's going to swing it one way or the other? Maybe Oracle?
Yeah, well, first, great to be with you. Listen, I think the big picture is the market and techs had a big move this first part of the year, and we're consolidating the gains. We're churning a bit here, but there's nothing wrong with that after you've had these big gains. And I think we're more likely to have that continue near term. But as you mentioned, the near-term catalyst is what we're going to listen to after the bell today with Oracle, because what investors really want to see is, we know that like NVIDIA and some of the chip names have seen some benefit from AI, but is that starting to broaden out to validate some of the premium valuations we're seeing in tech today?
Bob, you think bonds play a big role in which way the market goes from here?
I sure do. We've seen yields creep up again of late, and that's sort of stalled equities. Not today, of course, but I think when you push above 4.25 and the 10-year, that causes equity multiples to get a little nervous when they're selling at nearly 20 times earnings. Bonds are key here.
Okay. So then do you buy into bonds? Do you steer clear of bonds? How are you thinking about that, Bob?
I don't think we've seen the high in yield yet, but we've come a long way. So unlike 18 months ago when the 10-year yield was 1.5, a really bad deal, 4.25 is a lot better. So on weakness, we would be nibbling on bonds and are slowly extending our durations.
Yeah. Keith, the fact that you did see big tech companies, Tesla, you had that upgrade, power the market higher today. I mean, to dig in a little deeper on John's question to you earlier, is there a buying opportunity here, or are there other sectors in this market that are ripe for opportunity?
Yeah, when we talk about tech, you have to think about what are we talking about specifically, because within our sector strategy, we're overweight communication services and discretionary, because communication services has names like Meta and Google. Again, I'm not recommending individual names, but those groups still look good to us as far as relative valuations, momentum with some of the AI side. Consumer discretionary, the top two names in that sector is Tesla and Amazon. So I think you have to be more selective within the sector exposure as a whole. But I think today is a good day, as you mentioned. You get a little bit of news, some news around AI, and you see some of these stocks up 3, 5, 10%. So at this point, big cap tech still has some of that leadership, but again, it's a bit more bifurcated than just saying the S&P technology sector as a whole. So again, we're more neutral on the overall sector, but we're finding opportunities within, and I think one of those other areas is software as well.
Bob, it's one thing when we're talking about bonds to look at the yield sort of moving up and down day to day, but so many investors, just retail investors, families, are way off of that traditional 60-40, 60% stocks, 40% bonds, fixed income template. So if you're considering moving more into bonds, not as a trade, so maybe what happens day to day or week to week doesn't matter as much. If you need to move more into bonds to balance out your portfolio, is now the time to do it? And how do you do it?
Slowly and in a laddered approach, in my view. Look, I'm presuming somebody that's nibbling on bonds has a bunch of cash that's earning, call it 5%. If you don't, I'm not sure I'd run out and sell a whole lot of stocks to buy bonds, but cash, which has given us a wonderful return on an absolute basis and should be decent relative going forward, is the source for bond money should you want to add to those positions.
Keith, do you see the bond market the same way right now, or are you thinking about it differently?
No, I think there is some value in bonds, as Bob alluded to. I think it's tough to try to call a top. There's a lot of momentum. You're above, 425. But the way we're thinking about things for, let's say, the next 6 to 12 months, we think the risk reward is improving there, because even if yields continue up another 50 basis points, because of that coupon you receive in the total return, you're protected up to about 475, 480 on the 10-year. So we are actually extending, bond durations as a whole. And again, as we think about overall asset allocation, we're basically neutral against stocks, bonds, and cash because of all the mixed cross currents. But we think high-quality fixed income provides pretty attractive yields at current levels.
Keith, on the equity side, talk to me about why you like consumer discretionary right now, and why you're overweight the industrials sector specifically.
Correct. Well, the first thing with consumer discretionary, it's a quasi-growth sector. And again, we're more focused on the growth components of that. As I mentioned earlier, that the biggest components of that are Amazon and Tesla. So we like the growth component more than the deep cyclical consumer discretionary names. And then as far as industrials, we still think there's a lot of secular tailwinds if you think about the industrial sector as far as fiscal stimulus. We can think about the infrastructure bill where we'll see multi-year spending that goes into that as well. And then we're going to have this continued strategic battle with, we think about China and geopolitical side, defense spending should continue to increase as well. So we think all in all, the industrial sector will benefit from all those different secular tailwinds.